How's it going, guys? My name is Andrew. That's Professor Meatball. He's here looking for a treat. And if you guys are looking for a treat as well, we are about to say thank you, Jacob Watroba, for the super. Astrologer Joni Patry says March 25th, 26th will be the squeeze. Astrologer. Like a person that believes in astrology, that would be interesting. Well, if you guys are also looking on some advice on what to do when you are at a loss, perhaps you bought in at GME when it was at its highest in January, like me, or perhaps you are bought in when it was the highest a couple of days ago at 180. Well, we have a little bit of advice for you. This is not financial advice. This is just somebody's opinion on the internet, and I am not a financial advisor, but I did want to be able to share this person's opinion just in case this helps any of you. So, Diamond Hand Ape here. I wrote some basic advice I'll repost here for any newbies who want to get in on the action, or anyone who bought high and is, for whatever dumb reason, thinking about paper handing. Paper handing is fundamentally bad investment practice, especially if you're a new investor. They'll explain why. Disclaimer. They've only been trading for a few years, and they only know this because they had a mentor in finance who taught them this stuff, and he hasn't steered him wrong yet. So take it for what it's worth. Based on the fact that paper handing is even an issue here, you apes clearly need this advice. Edit. There are fundamentals to the way that I trade, and obviously everyone's trading strategy is different. Note that this is a quantitative approach to investing, which does not encourage YOLOing. This is one way to invest, which does not require you to outsmart the general public by spotting opportunities value before the market does. I feel it's particularly relevant to the GME play. The ticker symbol is less important than what you do with it. There are other approaches which often require more experience, but I feel like this is the most accessible to new investors. GME is the hot stock right now, but this applies to everything. Well, everything that you don't think will go bankrupt or get delisted. New traders or people who are thinking about becoming new traders should read this. Especially if you're new, I think that you should follow these guidelines to avoid losing serious money on the stock market. This applies to all stock, not just GME. If you're experienced, it might also sound like I'm explaining at length why 2 plus 2 equals 4, but since a friend of a friend told me that he paper-handed on the GME, basically sold the dip, it feels compelled to tell him why that was a bad idea. I would encourage people to buy GME, but only with money you are willing to say goodbye to for a while. Edit. In addition, just to reiterate, keep plenty of money in reserve so that you can buy more if the stock goes down. By this, I mean never sell at a loss. Simply hold or buy more to bring your cost average down. All newbie investors, in my opinion, should adhere to this rule just in general. Buy stock prepared to ride it to the ground, or don't buy it at all. Many investors, myself included, follow this rule religiously, not just with GME, but with all stocks. I have never lost money in the stock market because I never sold at a loss. I just held or bought more. COVID crashed the market while my portfolio was maxed out. I just held and was fine. You should have bought more. If everyone bought into GME with this mindset, I bet it would go to Pluto easily. If you sell at a loss, you are donating to the Save the Short Sellers Fund out of your own wallet. Just effing yourself over and betraying your fellow apes. And you're not even following sound investment practice. Just chain yourself to the rocket and enjoy. If you're thinking about investing so much that you'll wuss out, poop your diaper, or smash the sell button with shaking paper hands at the slightest hint of red, just don't. Emotion and the stock market do not mix well. Let's go and scroll down a little bit. Stop losses below purchase price are for pansies and genuine idiots. I'll sell you some stock, but only if you give me a bad enough price on it. Your plan should be buy when the stock goes down. If you feel like you need a stop loss, you're investing more than you should. Instead of being stupid, maybe try investing less and keep money in reserve so that you can buy the dips. Wow, this guy is being very, very this guy's being kind of obtuse. Side note, personally, in the case of GME, I don't have any limit sells either. From what I can tell you on past short squeezes, the price seems to go parabolic for at least half a day before coming back down. So as long as you can keep an eye on GME when it actually does skyrocket, you should have plenty of time. Set price alerts and relax. No need to shoot yourself in the foot by ditching the rocket mid-launch. Although, if you want to profit off of GME volatility, well, some people are getting shamed for taking profits, but I'm not sure they deserve it. As far as I know, buying low and selling high doesn't really help hedge funds. It drives the price up, just not as much as buying and holding. Personally, their philosophy, they can take baby profits anytime. Who knows when something like GME will happen again. So I'm holding 101 shares at cost average of $106 a share. So he really has only roughly $10,000 of GME. Want to get into the game now? You could always just buy a few shares and keep the rest of what you're willing to invest in reserve in case of a dip, and buy a little bit more each time it goes down more, bringing your cost average down. Ideally, you should always have a loose plan for how much you will buy at each phase if the stock goes down to near zero. Always try to keep cash in reserve. Locked yourself in a high price? That's why you keep cash in reserve, so you can buy the dip and average down. Didn't keep any cash in reserve? Guess you're stuck waiting for one of these three things. 1. The short squeeze, which will likely, though not certainly, happen. 2. For the price of GME to rise naturally over years of the value of the company increases. 3. You get your hands on some more cash you're willing to say goodbye to bring your cost average down. Do not sell at a loss and you will never lose. This is some crazy advice. This is some like insane people advice, but technically it is correct. Unless the company goes bankrupt, a rare occurrence. This is why you don't put all your eggs in one basket and you plan so even if you buy all the way until to zero, it won't swallow your portfolio. Also, if you've truly effed up and used money that you need for health insurance or something, you may just have to back at least partially out with your tail between your legs and consider it a lesson. Hedge funds and billionaires know this. That's why their wealth increased so dramatically during the pandemic. They bought the dip while regular folks paper-handed and got even poorer. One more little trick. If you manage to scoop up a nice juicy 100 shares, then even if your position goes underwater, you can always sell covered calls at above your average cost, bring down your cost basis, and make money off of your stock risk-free while still following the rule of never sell at a loss. Make sure that they are covered, i.e. you hold onto the actual stock for the duration of the call, otherwise it's extremely risky. Although if you sold even a covered call right this second, the risk would be missing out on a once-in-a-lifetime historic short squeeze. Bear in mind, though, it may take months for the squeeze to actually happen, and you'll need to be patient, like I said, say goodbye to your money for a while. Now, there is two important caveats that I think about this when I read it. One, money makes money. So if you want to invest money and then hold it in a place that doesn't make you any money, you have just lost out on the opportunity cost of investing in an asset that doesn't actually appreciate. So therefore, right now, if you are willing to say goodbye for your money for a long time, that's essentially the same as saying, hey, like invest in my Etsy shop or invest in my crazy startup idea and we'll make money eventually. Just say goodbye to your money for a long time. It's the same thing. Would you support your friend's crazy passion idea instead of actual strong fundamentals? 2, the idea that when you sell at a loss, you lose is only partially true. If you sell at a loss, you can take those losses from your taxes and then cut off parts of it until you actually make it back up. And that's actually a fair way to go about certain stocks. Now, therefore, what he is saying, selling the dip, is a very dumb thing to do, and you definitely don't want to do it too often. The main point of this article is to give you a couple of ideas of someone specifically passionate about never selling at a loss, and hopefully you learned a couple of things from this perspective. If you like this video, hey, I only ask that you like the videos that you like. Give this video a big fat like, give this video a subscribe, join the Meatball Army, the MBA, give this meatball a sub with the subscription button, also the bell button so you don't miss a single live stream, and I appreciate you guys being here. For now, but not for forever, I'll see you guys later. Peace.